Imagine this for a moment. A man is sitting in front of 3 glowing computer screens late at night. Within a few minutes, he places a trade. The stock price shoots up, and the next morning, he's a millionaire. That's the story we all like to hear, because it's simple, it's dramatic, and most importantly, it makes us believe that one smart decision in life can change everything. But after more than 50 years of watching the financial markets in the United States and around the world, from the 1973 crisis, the 1987 market crash, the dot-com bubble in 2000, the 2008 financial crisis, all the way to the market frenzy of 2020. I can tell you a truth that many people don't want to hear. Big wins rarely create lasting wealth, and the reality is even harsher than that. A lot of people get rich from one big win, and then lose everything from the next one. During the dot-com bubble in 1999, thousands of Americans became paper millionaires in just a few months. In that single year alone, the NASDAQ rose nearly 86%. It sounded like paradise. But just 2 years later, the NASDAQ lost almost 78% of its value. Millions of investment accounts were wiped out. Thousands of internet companies went bankrupt. And many of the investment geniuses of 1999 ended up going back to regular office jobs. The big win lifted them up, and the next big win wiped them out. I've met people like that. A friend of mine made $3 million in tech stocks in the late 1990s. He thought he had figured out the market. 3 years later, he had less than $200,000 left. Not because he was stupid, but because he believed in a very dangerous story. That wealth comes from a moment of brilliance. But if you look at the people who built the largest fortunes in modern history, you'll see a completely different pattern. What was the biggest win you ever experienced in life or money, and what lesson did it eventually teach you? I'd love to hear your story. Leave a comment below if you're willing to share that valuable experience with others. For more than 60 years, the average annual return of Berkshire Hathaway has been around 20% per year. That doesn't sound crazy, but look at what that number really means. If you had invested $10,000 in 1965, and it compounded at about 20% per year. Today, that money would be worth over $300 million. No magical trade, no single life-changing day. Just a slow, steady, and honestly very boring process. And here's the twist most people never realize. The things that truly destroy your finances are almost never big mistakes. They're tiny mistakes. A little mindless spending every day, an hour of scrolling instead of learning something new, a financial decision driven by ego, bit by bit, so slowly that you don't even notice it happening. There's a fascinating example of this in nature. When a house collapses, people usually assume it was caused by a hurricane or a massive storm. But in the United States, according to construction industry estimates, termite damage costs more than $5 billion every year, more than fire damage in many regions. Termites don't make loud noises. They don't destroy a house overnight. They simply chew through tiny pieces of wood every day for years, until one day the entire structure collapses. Personal finance works exactly the same way. Very few people become poor because of one catastrophic decision. They become poor because of thousands of small decisions repeated over 20 or 30 years. But here's the beautiful part of this rule. If small habits can slowly destroy your finances, then different small habits can slowly build an empire. In my 50 years of investing, I've noticed something fascinating. The average person is always looking for the next big win. But the people who become truly wealthy focus almost entirely on small habits repeated every single day for decades. And in the next part, I'm going to share 5 incredibly simple habits that I've seen over and over again among some of the most successful investors in history. They're not flashy, they're not exciting, but if you truly understand them and apply them, you'll begin to see the wealth-building machine that most people in the world never even realize exists. And the next idea might completely change how you think about your future. Let me show you a pattern I've seen repeat itself over and over again in financial history. When people think about financial disaster, they usually imagine a hurricane, a massive event, a sudden collapse, a moment when everything falls apart overnight. In the financial world, the hurricane looks like events such as the 2008 financial crisis, when the U.S. stock market lost about 50% of its value, and millions of Americans saw their retirement accounts cut in half. Or the dot-com bubble crash, when the NASDAQ composite dropped almost 78% between 2000 and 2002. Or the early months of the COVID-19 market crash in 2020, when the S&P 500 fell about 34% in just a few weeks. These moments are terrifying. They dominate headlines. They make people feel like the financial world is collapsing. Take a moment and ask yourself honestly, if something like that happened again tomorrow, how would you react? Would you stay calm or panic and sell everything? But here's the strange thing about hurricanes. They are rare. If you zoom out and look at the last 100 years of the U.S. stock market, you'll notice something surprising. Despite all the crashes, the S&P 500 has returned around 10% per year on average since the 1920s, even after the Great Depression, even after wars, even after multiple financial crises. In other words, the hurricanes are dramatic, but they are not what destroys most people's financial lives. The real destruction usually comes from something much quieter. The termites. Let me explain what I mean. In the United States, housing experts estimate that termite damage costs more than $5 billion every single year. Termites destroy more property annually than fires in many regions. And the most dangerous part is this: you rarely notice them. They don't smash through the walls. They don't make loud noises. They simply chew through tiny pieces of wood, slowly, quietly, every single day. For years, the house still looks perfectly fine from the outside, until one day the structure collapses. Your financial life works in exactly the same way. Most people don't go broke because they made one catastrophic investment. They go broke because of small financial termites that operate silently for decades. Consider a few real numbers. The average American spends roughly $3,000 to $4,000 per year eating out, according to data from the U.S. Bureau of Labor Statistics. That doesn't sound outrageous. But if that same $4,000 were invested each year into the S&P 500 and compounded at about 10% annually, after 30 years it would grow to over $700,000. A small daily habit quietly eating away at future wealth. Here's another termite. According to research from Nielsen, the average adult spends over 2 hours per day on social media. That's more than 700 hours per year. Over 30 years, that becomes over 20,000 hours. That's the equivalent of 10 full years of full-time work. Imagine if even a fraction of that time had been invested in learning about business, investing, or building skills. Be honest with yourself for a second. If even 10% of that time had been spent learning about investing, business, or skills, how different might your life look today? These are the termites, small, silent, invisible, but powerful over time. Meanwhile, the people who quietly build wealth usually do the exact opposite. Instead of feeding negative termites, they feed positive ones. A small amount invested every month, an hour spent reading instead of scrolling, a habit of saving before spending. Nothing dramatic, nothing exciting. But when those small actions compound for 20, 30, or 40 years, something extraordinary happens. The termites that once destroyed financial foundations begin quietly building a fortress instead. And once you understand that simple principle, you begin to see money differently. You stop worrying about the next hurricane, and you start paying attention to the tiny things happening in your financial life every single day. Because in the long run, those tiny things decide everything. After spending more than 5 decades studying markets, businesses, and human behavior around money, I've come to believe something that sounds almost too simple to be true. Wealth is rarely built by dramatic moments. It is built by systems of small habits, not heroic decisions, not perfect timing, just tiny behaviors repeated for decades. Before we go deeper, think about your own life for a moment. Do you believe your financial future will be shaped more by one big opportunity or by the small habits you repeat every day? This idea might sound boring, but history keeps proving it again and again. Let me give you a real example. If you had invested $1 in the U.S. stock market in 1926 and simply reinvested the dividends while doing nothing else, that single dollar would be worth more than $10,000 today. According to long-term data from the New York University Stern School of Business. No trading strategy, no secret formula, just time and compounding. This is why the greatest investors in history often appear almost strangely patient. Take Warren Buffett. Most people assume his wealth came from a few brilliant trades. But if you look at the actual numbers, the story is completely different. About 99% of his net worth was created after the age of 50, and nearly 90% after the age of 60. Not because he suddenly became smarter later in life, but because his habits had been compounding quietly for decades. Every year he invested. Every year the capital grew, and every year the growth itself began producing more growth. That's the real machine behind long-term wealth. Another example comes from the world of retirement investing. Studies from Vanguard Group show that investors who simply contribute consistently to index funds and rarely trade tend to outperform the majority of active traders over long periods of time. Why? Because frequent trading interrupts compounding, and compounding is the entire game. But here's the part most people misunderstand. Compounding doesn't just apply to money. It applies to knowledge, behavior, and decision-making. Over the years, I've noticed a subtle but powerful difference between people who eventually build wealth and those who struggle financially. The wealthy tend to develop small daily disciplines. They read a little more. They save a little earlier. They think a little longer before making financial decisions. Individually, these behaviors look insignificant, but over time they create something powerful, a compounding advantage in judgment. Let me give you a practical example. Imagine two people starting their careers at age 25. Both earn the same income. One of them invests $500 a month into a broad market index fund. The other decides to wait until later and starts investing at 35 instead. If both earn an average return of about 10% per year in the S&P 500, the difference by age 65 becomes enormous. The first investor could end up with over $1.3 million. The second might have less than $500,000. Same income, same investments. The only difference was 10 years of small monthly habits. That's the invisible power most people underestimate. And I've seen this principle play out not only with individuals, but with entire companies. Look at businesses like Apple or Microsoft. From the outside, they look like overnight success stories. But if you study their history carefully, what you find is something much less glamorous. Thousands of small improvements, better products, better systems, better decisions repeated year after year. That's how empires are actually built. Slowly, quietly, systematically. And here's the paradox that most people never notice. Because these habits are small, they feel optional. Skipping one investment contribution feels harmless. Skipping 1 hour of learning feels harmless. Making one emotional financial decision feels harmless. But when those tiny choices repeat for 10,000 days, they begin to shape an entirely different financial destiny. That's why, after studying markets for so many years, I no longer look for genius. I look for consistency, because the truth is this. In the long run, the person who makes slightly better decisions every day will outperform the person who occasionally makes brilliant ones. Small habits don't just build wealth. Given enough time, they build empires. Keep watching, because the next idea might be the most important one in this entire video. After decades of watching investors succeed and fail, I've noticed something that most people completely miss. The difference between those who quietly build wealth and those who stay financially stuck is not intelligence. It's not luck. It's not even access to information. Today, almost everyone has the same information in their pocket. The real difference is something much less exciting: daily habits. Tiny decisions repeated thousands of times. And if you ignore these habits, the consequences can be brutal. Not immediately, but slowly, year after year. Let me show you 5 habits I've seen again and again among people who build real wealth, and more importantly, how you can apply them in real life. Habit 1, the too hard rule. One of the most dangerous forces in finance is ego. People want to feel smart. They want to prove they understand complex things. So when a friend talks about a complicated crypto project or a revolutionary startup or a real estate deal with a 70-page contract, most people pretend they understand it. This is how people lose money. Great investors do the opposite. They are comfortable saying, "I don't understand this, I'm out." Warren Buffett built much of his fortune using this exact rule. For decades, he avoided technology stocks because he didn't fully understand them. During the late 1990s tech bubble, he was mocked constantly on financial television. But when the dot-com bubble crash erased trillions of dollars in market value, his discipline protected him. Practical application. Before investing in anything, ask yourself, can I explain exactly how this business makes money in 60 seconds? If the answer is no, put it in the too hard pile. Ignoring bad opportunities is often more valuable than finding good ones. And this is the part most people never talk about. Habit 2, feed your mind with permanent knowledge. Most people think they're learning about investing. In reality, they are consuming financial entertainment. They watch market news, they scroll social media, they follow hot stock tips, but most financial news becomes irrelevant within 24 hours. That information has almost no long-term value. Successful investors feed their minds with something very different: timeless knowledge, business history, human psychology, economic cycles. Charlie Munger once said he had never met a wise person who didn't read constantly. And Warren Buffett reportedly spends around 80% of his day reading. That may sound extreme, but think about the long-term effect. If you read just 30 minutes a day, that's roughly 180 hours per year. Over 20 years, that's 3,600 hours of learning. That level of knowledge creates a massive advantage in decision-making. Practical application. Replace 30 minutes of daily scrolling with business books, biographies of entrepreneurs, investing history. The knowledge compounds even when money doesn't. And what happens next might surprise you. Habit 3, master the power of doing nothing. This may sound strange, but one of the most profitable habits in investing is patience. Human beings hate waiting. When markets drop, people panic. When markets rise, people chase trends. Both behaviors destroy wealth. According to studies from Dalbar, the average investor consistently earns far lower returns than the overall market, not because markets perform poorly, but because investors constantly buy and sell at the wrong time. The market rises, people buy. The market crashes, people panic and sell. Great investors learn to sit still. During the 2008 financial crisis, many investors sold their stocks near the bottom. But those who simply held their investments saw the S&P 500 recover and eventually reach new highs. Practical application. When markets become chaotic, do something very difficult. Nothing. Sometimes the most profitable move is simply not reacting. Habit 4, respect capital. One of the biggest reasons people never build wealth is something economists call lifestyle inflation. Income increases, and spending increases even faster. New car, bigger house, more expensive vacations. The result? Higher income, but no real financial freedom. Many high-income professionals still live paycheck to paycheck. A study from the Federal Reserve found that nearly 40% of Americans struggle to cover a $400 emergency expense. Even among households earning over $100,000 per year, many have very little savings. Why? Because spending quietly expands to consume income. People try to look rich instead of becoming rich. Real wealth builders do the opposite. They control lifestyle growth. Warren Buffett still lives in the same house he bought in 1958, not because he can't afford something bigger, but because he understands something most people don't. Every dollar you spend today is a soldier that will never work for your future again. Practical application. Every time your income rises, do not upgrade your lifestyle immediately. Instead, upgrade your investments. Habit 5. Build an inner scorecard. This may be the most powerful habit of all. Most people make financial decisions based on other people's opinions. They buy cars to impress neighbors. They take vacations for Instagram photos. They choose careers to impress their family. This is what psychologists call living by an external scorecard. It's exhausting and financially destructive because the desire to impress others leads to irrational spending and risky decisions. Great investors live by an internal scorecard. They ask one simple question: if nobody else knew about this decision, would I still make it? During the late 1990s tech mania, many investors bought internet stocks simply because everyone else was doing it. Warren Buffett refused. For years he was criticized publicly. But when the bubble collapsed, that discipline protected billions of dollars. Practical application. Before making a financial decision, ask, am I doing this for my future or for someone else's approval? If the answer is approval, it's probably a bad financial decision. The warning most people ignore. None of these habits are exciting. They won't make headlines. They won't make you feel like a genius. But ignoring them has consequences. Not tomorrow, not next year, but over 20 or 30 years, the difference becomes enormous. The people who master these habits slowly build financial security, freedom, and opportunities. And the people who ignore them often spend decades running faster and faster without ever getting ahead. Because wealth isn't built in dramatic moments. It's built in thousands of quiet decisions no one else ever sees. And if you truly understand that principle, you've already taken the first step toward building something most people never achieve: lasting wealth. After spending more than half a century studying money, markets, and human behavior, I've come to a conclusion that surprises many people. The financial world is not nearly as complicated as it appears. What makes it confusing is not math. It's human behavior. I've watched brilliant people with elite degrees lose fortunes in the market, and I've watched quiet, ordinary individuals build life-changing wealth over time. The difference was almost never intelligence. It was discipline and time. Over the last 50 years, markets have experienced wars, recessions, inflation crises, and technological revolutions. We've seen the 1,987 stock market crash wipe out more than 20% of the U.S. market in a single day. We've seen the global panic of the 2008 financial crisis. We've watched the rapid collapse during the COVID-19 market crash. Each time, people believed the system itself was breaking. And yet, through all of it, the long-term trajectory of the S&P 500 has continued upward for nearly a century. Markets recover, businesses adapt, innovation continues. But individuals often sabotage themselves long before the market ever does. They chase trends. They panic during downturns. They upgrade lifestyles faster than they build assets. In other words, they lose the game not because the system is impossible, but because they refuse to play the long game. And this is the insight that only time in the markets can teach you. The people who ultimately succeed are rarely the most brilliant investors in the room. They are simply the ones who stay in the game the longest, with good habits working quietly in the background. Think about it this way. If someone consistently invests a modest amount into the S&P 500 every month for 30 or 40 years, reinvests dividends, avoids emotional trading, and keeps their spending under control, they don't need a genius strategy. Time will do most of the work. Compounding will do the rest. Meanwhile, the person constantly searching for the next hot investment, the next market prediction, or the next shortcut to wealth often ends up resetting their progress again and again. It's like running on a treadmill. Lots of effort, very little forward movement. And that brings me to the most important lesson I can share after decades in finance. Wealth is not created by spectacular moments. It is created by quiet consistency. The person who invests steadily, learns continuously, controls their spending, and ignores the noise of the crowd is quietly building something powerful. Not just money, but freedom. Freedom to make career choices. Freedom to survive economic shocks. Freedom to live life on your own terms. And when you look back after 20 or 30 years, what once felt like small habits will have turned into something much larger. Not overnight success, but something far more reliable. A financial foundation that no crisis, no trend, and no temporary market panic can easily destroy. That's the real secret of wealth. And it's available to far more people than most ever realize. After everything we've talked about, the lesson is actually very simple. Wealth is not built by the smartest person in the room. It's built by the person who can stay disciplined the longest. The modern world keeps telling you to move faster, chase the next trend, find the next hot investment, jump into the next big opportunity before everyone else. But the truth I've learned after decades in the financial world is almost the opposite. The people who quietly win the game of money are usually the ones who do a few simple things, over and over again, for a very long time. They invest consistently, they keep learning, they control their spending, and most importantly, they ignore the noise of the crowd. Because in the end, wealth is not a sprint. It's a 40-year marathon of decisions. And every small habit you repeat today is quietly shaping where you will stand in that marathon 10, 20, or 30 years from now. So here's a question I want you to think about tonight. If your financial habits stayed exactly the same for the next 10 years, where would your life end up? Take a moment and be honest with yourself. And if this video made you think differently about money, I'd really like to hear from you. What is one small financial habit you want to start changing this week? Leave it in the comments below. I read them, and your story might help someone else who's on the same journey. And if you enjoy thoughtful conversations about money, long-term wealth, and financial psychology, consider subscribing to the channel. Because here, we're not chasing quick money. We're learning how wealth actually works in the real world.